Okay, folks, welcome back. Today we're going to be doing module number 3, dealing ranges and range dynamics. Very important module in the foundation. Everything derives from your dealing ranges and your range dynamics, okay? So let's get started. Okay, defining the dealing range. 100% range framework within which price can 100% range framework within which price consolidates, expands, and reverses, right? Range equals containment system for price behavior. Okay? So the range is where you expect price to be in and you expect certain behaviors to unfold. For example, a 243 pip PO3 dealing range defines an intraday structure for GBP USD. Okay? Like the boundaries of a soccer field, play happens inside, but goals, stop runs, occur when the ball crosses. Okay? And I'll give you an example of what that looks like. This is a dealing range on NASDAQ, right? 729. The containment price is contained in this range. And when the price creates a stop run, goes outside of this defined range, then you'll see an actual price behavior unfold, right? So this is your consolidation stop run and then reversal to start the actual structure of price, right? That's what you're seeing here, right? Like boundaries of a soccer field, play happens inside, but goals, stop runs occur when the ball crosses. And that's what we're seeing here. It crosses, and then we'll see actual price uh, start to unfold bearishly in this example. Okay? Expansion and contraction. Expansion equals move from smaller to larger PO3, from an 81 PO3 to a 243. That's an expansion of your PO3. A contraction equals the reverse, 243 to an 81. It's slowly going a smaller PO3, right? It's going down. Reflects volatility regime shifts. This is important, right? So if you see prices in a smaller 81 range, it might be safer to wait until you get a volatility injection that moves you to a higher PO3, which is a great condition for expansion, right? A great condition for getting those trades that really move very quickly to your take profits and to your draws on liquidity, right? So this is a volatility regime. You can measure this by seeing what price is doing currently in your in price action. Okay, and this is what that looks like. If price is just in this age 81 and you have your drawn liquidity at the bottom of 243, right? You want to wait until you start to see an expansion, a volatility injection that will move you through these PO3s to a higher PO3, right? It's breaking this one and it's forming this 243 PO3, right? It's forming into this is expansion to this bigger PO3 that's unfolding. And versus when it's finished doing this, you'll see sometimes that price will go back into an 81 point range and it'll slowly generate liquidity before continuing and entering a new stage of price action, a new stage of creating a wider and bigger PO3 range. Okay, so this is an example of what we just seen here. It'll contract, it'll go smaller, and it'll go bigger, right? It'll contract in this 81, and then certain sessions, certain openings will inject volatility, will create and start unfolding this bigger 243 range, right? And you can kind of see that happening here between midnight and 7:30. We are in this small tight range, and as New York Open begins, we'll see this huge expansion of with the volatility coming in, and we'll see bigger waves, if you will, bigger movement in price um, when we're trading, right? And that's expansion and contraction that's going on. Next, we have the optimal dealing range. Um, I'll show you an example of what this looks like. 2 to 3 major reactions on a zone. Too small equals noisy, too large equal a dead zone. Use higher time frames, 4-hour daily, to identify Goldilocks PO3 values. Like tuning a radio, too much static is a small range, or silence, a large range. Clarity lies in the balance of the two. Okay. Um, and for that, do I have a good example of this? Okay, so you see all of these reactions between these levels. These black lines are the main GB levels. You want to see 2 or 3 reactions a day on maybe 2 to 3 levels, right? If they're too close, it's too noisy, right? There's too much going on. You can't get a correct read. But if there's enough space in between each GB level, that means you're in an optimized dealing range. Okay? You want enough space so that price can fluctuate between them and you can get a good read on the market, right? Versus during this session between uh, Asian session, you see this is a very small range. Not enough touches are going on between the actual GB levels. You can't get a good read. So in this case, you might want to go down to a smaller PO3 for a more optimized dealing range. Okay, and that's what this is for. This optimized dealing range. Okay, an intended dealing range is not as quite important. I'll go over it. Intended dealing range, long-term equilibrium zone. An asset gravitates towards, often multi-year. Example: Bitcoin forming intended dealing range at PO3 531 441 range, a macro consolidation level, like tectonic plates slowly expanding until reaching new equilibrium. Um, this is an important part of understanding dealing ranges, but for how we're trading, it's not important to dive deep. If you want to know more about intended dealing ranges, I encourage you to go check out Hoppy's book. He has a lot of information on that. He goes more into detail, but I'm not going to harp on this because it's not extremely pertinent to uh, creating your trade idea, okay? And I'm gonna end the video there. Our next video is gonna be on time and look back partitions. Um, very great section of the book. You definitely want to come back to check out the time and look back partitions, especially if you want to get more confident in timing certain markets and timing certain things. Okay, so we'll end the video there.